Good evening, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a very good day in the markets today, and that you had a very beautiful weekend as well. And in today's action, the S&P up 0.5% and the Qs up 0.77, and that's building upon some of the nice gains that we saw on the Friday session, whereby the S&P was up almost 2% and the Qs were up over 2%. The indexes are now finding their ways somewhat back to their all-time highs. The Qs still shy, but the S&P very close, which kind of raises the question, right? Is the sell-off done? Is the volatility done as well? Is it safe to be deploying capital? Maybe not in some of the names that are perpetually at highs, but potentially some of the names that have sold off recently, or is there more to come? Basically, is this possibly a rally onto new all-time highs and a recovery of those sectors, or is it just a bull trap with more downside to come? Of course, we'll be talking about that in today's video, and speaking about today's video, we've got a lot of things to cover. Number one, we'll be going over some key pieces of news that came out today that I thought would be interesting for our analysis, so we'll do that first. Number two, we will cover our major sectors in the market and take a look on that rotation, see which sectors are outperforming, which sectors are underperforming, and where we could possibly make the best use of our capital if we're seeking to benefit from some of these ongoing rotations. Moving on further, we will then take a look at our big tech list down here, and since many of these tech companies have sold off significantly after their earnings, are any of them good buys right now, or should we possibly stay away because of all of those capital expenditures that these companies are doing in the quest of being dominant AI players? So we'll take a look at this list and derive some possible entry opportunities if they are indeed valid. And at the end of the video, of course, we will take a look at our biggest gainers and losers. To the downside, we had many companies here, some down 3, 4, 5, some down 16 and 20. So we'll talk about these and also several names that had a very good showing today. Speaking about some of the AI data center connectivity plays, some of the neo cloud providers like CIFR. Very nice performance here across the top end of this list. So we'll cover some of these names at the end of the video and derive which of these plays are very good for possibly swing trades or maybe even long-term portfolio pickups as well. And at the very end of the video, since we haven't done it in a while, I'll give you guys a bit of a portfolio update. We've been spending so much time in the last 2 weeks covering the market sell-off and the sector rotations and the earnings, of course, that the videos have been very long and I haven't had time to squeeze in the portfolio recap, so I'll do that at the end of today's video because we won't be covering any earnings today. And that's going to be it for today, guys. So without further ado, let's get right into it, shall we? So as we said, the S&P up about 0.5%, the Qs up about 0.75% on a day like today. If we take a look at the heat map was not all that bad today. We did have some pullbacks in consumer defensives, aka consumer staples, and they've been red hot to start off the year. This was one of the best ideas that we were pitching on the channel very early January. This XLP trade and the energy trade down below for oil and gas. So far they've worked out well, but today was a bit of a pullback there. Now the money did find its way into some of our tech names today. Microsoft up a healthy 3, Oracle, Palantir all up, a lot of cybersecurity names up as well. NVIDIA, Broadcom, AMD having some good days. Tesla, Meta, Google not too bad. It's just Amazon and Apple slightly lagging behind, but you did get some rotation back into software, not in all of software, but a little bit, right? If you take a look at your IGV ETF, which is the commonly used ETF for measuring the performance of the broader software index, you can see that, well, we came into big weekly oversold conditions, huge daily oversold conditions, and you got a bit of a snap back. Now, 2 days worth of green after a monstrous sea of red is nothing to scream home about, but possibly embarking into a bottoming out process. We may not be calling for a massive V-shaped recovery, but possibly the start of a longer, more drawn out bottoming process where we could see the bulls recapture a bit of ground. But of course, this is going to be an ongoing story. We know that the threats of AI to some of these businesses are very real in terms of both efficiency, but also in terms of narrative, right? The sentiment is very strong against these companies right now. Other than that, the financials category was fairly mixed on the day. The credit card companies still suffering a little bit of negative sentiment since the whole 10% cap on interest rate for credit cards that President Trump was talking about early January. By the way, the date that was supposed to come into effect was supposed to be January the 20th. We are now February 9th. And still no 10% cap, but the negative sentiment overhang somewhat remains. Healthcare, a bit of a consolidation today, and the bottom half of the market, not too bad. So the market breadth is still okay, in my humble opinion, and I'm going to share a few statistics with you guys in a few moments here. The one-day relative shows the most of the market was higher led by materials, technology, and energy. Shout out to communication services. Not too bad, right? That was Google and Meta. You can kind of thank them for those gains. To the downside, defensives, healthcare, and cyclicals. That being said, after a brutal sell-off period last week in a lot of tech names, I mean, the breadth of the market is fairly resilient right now. Most of your market indices are indeed higher, or rather your market segments. The only ones kind of lagging still, technology, healthcare, cyclicals, and communication services. But for the most part, guys, the breadth is not bad. It's just there's been a massive rotation since the beginning of the year. Take a look here at your year-to-date performance, right? You'll see it's kind of concentrated into the sectors that we were highlighting very early on in the year. Consumer staples, very strong. Industrials, very strong. Real estate utilities, not as strong, but still very green. And the energy trade, one of the best trades. That ETF, up until Friday at the close, up 19% year to date. After doing absolutely nothing for the past 4 years, we talked about it so much, how this energy ETF, oil and gas, could do very well. And so far, so good. They are doing pretty well. So interesting rotations to start off the year and to start off the month of February as well. We'll talk more about that, of course, in today's video. Fear and greed right now still stays planted at about a neutral rate of 48. You might remember last week at the peak of the sell-off, it was about a 33, 34 on Wednesday and Thursday, and now clawing back into neutral territory, so not too bad there as well. Now, before we get into more charts, let us go over briefly some key pieces of news or statistics that I thought would be interesting for our analysis today. So number one, we'll take a look right here in terms of market breadth. So I promised you guys we'd be looking at market breadth. We do it every video, but this one is a very interesting statistic. Market breadth is currently still surging. 66 almost percent of the S&P 500 stocks have outperformed the index over the last 3 months, the highest reading since late 2024. Now, of course, this is in contrast to a period of time where we were highlighting last October, where the market found itself into an extremely concentrated position, right? Where only AI names and Mag 7 names were running, and the whole rest of the market was kind of left behind. And you can see that on this chart right about there. I don't know if my head is in the way. Let me just double check it. No, it's not. So you can see here at the very end of 2025, this big drawdown right there into the 26% of all stocks were outperforming the S&P. That was October, and that's what led to a more broad market decline when we lost that AI trade. But now it's a different story, right? The indexes, for what it's worth, they haven't moved much in the past 3-4 months since that October peak, nor the SPY, nor the QQQs. However, the market breadth has been significantly improving, and that is indeed a good thing. This marks a sharp reversal from late 2025 when the percentage hit 26%, which did signal extreme concentration in mega cap companies. And you might remember me sounding off the warning signals back in late October saying that's not really sustainable. When you have breadth this high though, that is sustainable. So I did think that this was interesting too. Now, moving on to some of the earnings highlights so far, although the price action for our earnings hasn't been the best, the actual numbers from earnings have been very good. For Q4 that we're reporting right now, 59% of the S&P 500 companies have reported so far, 76% of them have reported a positive EPS surprise, and 73% of them have reported a positive revenue surprise. So although you may not see favorable price action in some of your favorite stocks, you can find some solace in the fact that, well, their earnings overall have been very good. Companies are beating their expectations and providing very decent guidance. For Q4, the blended year-over-year earnings growth rate for the S&P is 13%, which is a very strong EPS growth rate. Now, if you take a look at the sector by sector breakdown, which I'll highlight right here, the ones that came in line above or over the estimates, let me try to see if I can maybe zoom this in a little bit more without making it too large for you guys. So take a look at the breakdown by industry right here. You'll see that communication services on the left-hand side, 100% of companies that have reported have come in above, which is very strong in terms of their earnings estimates. And technology, the sector that has suffered a lot of declines recently throughout this earnings period, well, only 5% of companies that have reported so far have come in under the expectation, with 95% of them coming in above. They're actually one of the best components of the market in terms of earnings resilience and also just earnings performance. So very strong, whereas real estate is kind of at the bottom end here, as is consumer discretionary. So information technology is still a very popular trade in my humble opinion, despite the price action not showing as much. Moving on a little bit further here, just to remind you guys the reasons why we had such sharp declines over the past 2 weeks, from the Microsoft earnings, Meta giving back all their earnings gains, even Google coming down after earnings, Amazon down 10% after their earnings, right? Well, it's because of all this CapEx. But I'll remind you, at this point in time, guys, you really have to make a decision as an investor of whether or not you believe in the AI trade. On the channel, we've spoken many times about this trade and how I am a firm believer in the AI trade, but I do say that it does come with a bit of an execution period, to where I always show it on the chart of Oracle because they're the best metaphor for this one. Well, not metaphor, but they're the best example of what's going on. Previously, in early 2025 into mid 2025, there was huge amounts of capital being deployed for data centers and things of that nature. And there was a lot of hype, right? OpenAI was signing partnerships with everybody. And you were seeing just a whole lot of money flow between these companies. Now we are in a bit of a turbulent stage, which I refer to as the execution stage, where these data centers are being built, but we don't have any tangible efficiency or productivity gains or any big gains in revenue just yet. I mean, the hyperscalers are showing great cloud revenue growth and things of that nature, but they are still constrained by a lot of by some supply, right? And that being said, this is the second phase of the AI expansion, which everybody is looking forward to. So if you're choosing to buy some of these dips in the hyperscalers or your other favorite AI companies, you are waiting for this phase of expansion, right? Some people believe in it. Some people think the tech companies are spending too much money on it and that the gains won't be that substantial. The one thing that is true, though, is that we are in the execution phase, and this is also known as the shakeout phase. This is when you, as an investor, have to make the decision. Do you believe in this next rally or this next phase in the AI revolution, essentially? Or do you think that companies will just get stuck on this execution phase, spend too much money, and not have anything to show for it? I can't make that decision for you, right? I'll show you the statistics, we'll go over the earnings, and I'll give you my opinion, but at the end of the day, it is your money, and you have to make that decision because AI is going to be a prevalent narrative for the markets over the next 2, 3, 4, 5 years, guys. So it's like now is the time that you have to make that decision whether or not you want to rotate out to certain segments of the market that have been performing well this year, a bit more value oriented, or if you want to continue to add to some of these AI positions that are down. The CapEx is very real. These companies are indeed good for the money, but I will remind you, these companies, these big tech companies, not so much Oracle, but the Mag 7 companies, well, they used to be buyback kings. They used to be very free cash flow rich companies because of the fact that they used to buy back a lot of shares with their free cash flow and not spend so much money on capital expenditures. But if you take a look here at these share buybacks, well, you can see that we're kind of back to 2018 levels. The buybacks have kind of just fallen off a cliff slowly as these companies over the past 2 years have invested tremendous amounts of money into this AI trade. They definitely see a big opportunity. Meta slashing share repurchases to a combined 3.3 billion, down from 33 billion in 2021. That's a 90% cut, investing everything into AI. At the same time, Alphabet cut buybacks to 17 billion. That's half of what they spent in 2024 when they spent about 30.6 billion. And Amazon hasn't bought back a single stock since Q2 of 2022. So these companies, we covered their earnings. They see a massive opportunity. They are seeing some efficiency gains so far. It's just the fact that, do you believe in what they're saying, right? Do you believe that there's such a big opportunity that could warrant further investments from you? I am personally investing more in these companies as I do believe them to be some of the strongest companies in the world. And as a result, right, I am happy that some of these stocks are declining. They may have been a bit slow since the month of October, but I do believe it's a nice opportunity. Some of you may not agree, and that's perfectly fine. That's why everybody has a different investor risk profile and different penchants for different aspects of the market. If you wanted to concentrate on other aspects of the market, such as, you know, the rotation we've talked about many times since January, the expansion of the value trades, the dividend trades, the industrial section of the market, perhaps some energy segments, that is perfectly fine. You can also find some great deals in the financial segments as well, so keep that in mind. Now, moving on into our technical analysis portion of the video, because that wraps up our news segment. Well, In the S&P, guys, the S&P is not looking too bad. We've done a nice job in terms of recovering the declines that we faced last week, but keep in mind, we do have a couple of catalysts this week to pay attention to. Number one is going to be the retail sales metrics that come in tomorrow at the market open. That could be very interesting in terms of a gauge into the health of the consumer, but the bigger ones arguably are later on in the week. On the Wednesday session, you get the non-farm payrolls. They were supposed to drop it last Friday. They didn't do it. They delayed it until this Wednesday. This one's definitely going to be the one that has the best chance of moving the markets this week. The expectation is supposed to come in at 70,000 jobs versus the 50,000 that was added in the last time this was measured in the month of December. So keep that in mind. If this one comes in wildly under the estimates and even comes in at a negative print, the market's not going to like that, right? If you come in with a little bit of softness, it's once again going to be probably construed by the market as being bad news is good news in terms of pushing the Fed possibly towards a more accelerated rate cut path, because they don't want the labor market to deteriorate that much. We know that inflation is no longer much of a concern for them. They've said that in the last two meetings, how they're just not seeing the effects of inflation on tariffs just yet. They're not completely disregarding it, but obviously, inflation is no longer front and center for them. It really is the jobs market. And matter of fact, take a look at the trueflation gauge right here. I mean, it's very low right now, guys, 0.68% on the year-over-year comparison. And you can see that even across all categories, we're coming down, whether that's housing or clothing or food, both at home and not at home as well, utilities, transportation, everything kind of trending to the downside in terms of these inflation metrics. And I like this website right here because it's 15 million plus different products and services measured on a daily basis. So arguably a better gauge of inflation than things like CPI. But speaking about CPI, you do get a CPI print on the Friday session. It'll be interesting to pay attention to. The consensus is for a 2.5% print on CPI, whereby last month we did get a 2.7 print. So it would be an improvement. And if it does come in under last month, I do think that the market will enjoy that as well. So most of the attention should be focused on this non-farm payrolls report on Wednesday. Additionally, you do have more earnings, a lot more earnings. It's just no crazy large companies that could impact the markets in a big way. But we will be covering some interesting earnings together on the channel. Tomorrow, we'll probably be covering Robinhood, Spotify, and perhaps S&P Global. On the Wednesday session, we will be covering Shopify and perhaps AppLovin and maybe one more, whether that's Vertiv or McDonald's. I'll make that determination at that time. On Thursday, I have some interesting ones as well in the names of Nebius, Coinbase, Brookfield, right? Net as well could be very interesting, and a few more. So you can see kind of the layout for this week. It's a little bit less supercharged in terms of mega cap companies. Obviously, those are all behind us at this point, but very interesting, both growth and value companies. You can see Coca-Cola on this list, right? McDonald's and a couple other key value players. So definitely something for everybody to pay attention to this week. And we'll do our best to kind of recap as many of those as possible as we move throughout this week. But let's just say it's a less serious week for earnings, but still a week in which we could find some possible nice opportunities if the sell-off after earnings for a lot of these tech names persist. Like, let's say, Shopify posts very strong earnings and sells off 10% in spite of very strong earnings. Well, that would indeed be a very nice buying opportunity because, a lot of these tech companies into their earnings have sold off tremendously. And it doesn't mean that they're not solid businesses. They are. It's just the sentiment kind of took over this trade right now, and they've kind of suffered. So that being said, into this week, we do have some volatility elements in terms of the non-farm payrolls and perhaps some extra volatility in individual names because of their earnings. But overall, the S&P has kind of mounted back above this key area of support structure that we've been referencing for the longest time at this point. It seems like, right? This whole 685 to 679 location. I mean, they lost the daily uptrend. Now you got a really nice bounce by the bulls. So putting a lot of space between us and these 676 lows. So in the event that we choose to consolidate a little bit more into tomorrow's action or Wednesday, right? You got a nice support cushion, 685, 686, down to about 679. What you're looking for here is the bulls to just expand on this trend. It's kind of just been gridlocked over the past, let's say, since November, but realistically, right, not much in terms of net new highs since this October print. We're barely above that one by a percentage point, so keep that in mind. Daily structure is not too bad. The weekly structure is still kind of gridlocked here as well, right? It's very, very, very tight price action. The bears not able to close a weekly candle below this 12 EMA, in spite of the fact that they've tried a few times over the past month, not able to do it. And as a result, your monthly time frame here just continues to consolidate sideways with a slight bullish bias. So keep that in mind. Moving on to the QQQs right now. The Q's up 0.77%. This one sold off in a larger fashion, obviously, right? We were looking for the uptrend expansion. Sadly, big tech earnings caused a lot of this decline. Now we find ourselves in the downtrend. Now the bulls really have to struggle to kind of get this back. Now they're trying to mount back above this support range, which is 613 at about 605, but they haven't quite done it yet. And once again, we have been just gridlocked here. A big old consolidation range for the past, let's call it 4 or 5 months almost at this point, since those highs in October. So although the price action doesn't look too dire in the short term, we have recovered a lot of this decline. Top to bottom, it wasn't that severe, right? It was only about a 6.5% decline, which is, I mean, we saw a higher one back from October to early November. That one was almost 9%. Overall, we haven't really broken many key elements of structure. As you can see right here, the clearest time frames, in my opinion, are the weekly, although we had a bit of a tightening up pattern right here when we were going for the breakout, which then kind of transformed into this awkward little breakdown. We haven't really lost any key levels, right? It is still arguably a very wide range right now. Even if you take a look at the monthly, right? It's just monthly consolidation. You don't really see any red flags right here. Sure, we're kind of cooling off the RSI, and that's very good. And then monthly 12 EMA is kind of curling up higher. And as a result, if we just kind of consolidate sideways continuously and the 12 EMA catches up, usually when we can find the cues around the 12 EMA in the context of a very nice bull market, it's been a very nice opportunity to kind of just keep adding into some of our positions, especially since we know a lot of the macro for this year is quite good. The GDP ratios are quite good. Unemployment situation stays pretty much gridlocked at a no hiring, no firing environment. And inflation continues to trend down, and we are in a slow rate cutting environment, but a rate cutting environment nevertheless. A lot of companies are also beating their earnings. So can we find certain little bearish elements here in the market? Yes, but can we point our finger on one thing and say this is an absolute disaster and could lead to one of the greatest recessions we've seen in 20 years? That's a bit of a stretch, right? I always try to give you guys, very objective information on the channel and try not to lean too much in one direction. But that being said, I do still think that there are many things to look forward to this year, namely the earnings guidance that we have from a lot of these companies. We've heard from the banks, we've heard from the credit card companies, we've heard from certain discretionary companies that we've covered on the channel, we've heard from the tech companies, right? Nobody is really guiding for a negative macroeconomic environment, and nobody's really guiding for a very poor performance in terms of revenue and or EPS growth this year. Profits are still very high, so keep that in mind. Moving on to our financials ETF right now. Financials has been very awkward recently, right? They're trying to go for the daily uptrend expansion right now. The daily trend is somewhat soft. 54.5 down about 53.25 is going to be your support range that we're trying to, or resistance range we're kind of trying to get through right now. The clearest time frame for me is still the weekly. Higher lows, trying to go for that expansion. They are holding this nice support range low right there. Not too bad. And the monthly time frame also showing that this sector is in a nice little expansion phase of the market right now. Some of my favorite plays, it goes without saying, right? Visa, MasterCard. I know these are very boring companies and they haven't been doing much, but if you're a long-term investor and you're looking for things to kind of counterbalance your growth, I don't think you can go wrong with some of the large network effect companies like Visa and MasterCard. Tremendous margins, tremendous free cash flows as well. And additionally, in this niche too, we can talk about names such as Moody's Corporation and SPGI, which have sold off recently because they were lumped into the software trade. I know these companies as well haven't really done much over the past year and a half, but it's not that they haven't been improving their earnings. They have, and they're trading at very cheap valuations. So if you're a long-term investor and this is your style of company, Visa, MasterCard, Moody's, SPGI, very wide moat companies, very high margin companies, great business models, toll booth companies, you may want to look into these because they don't offer these discounts all the time, and usually they do translate into very nice longer term buying opportunities for some multi-year holds here. Moving on to the healthcare industry. Well, healthcare, bit of a down day on healthcare, but once again, even healthcare has been kind of stuck in this whole range. Let's call it between the 160 area and the low 150s. No expansion whatsoever. So the bulls are trying something here and you got to give it to them, but it just looks like we're very tight right now. The weekly time frame shows it best, right? Just a lot of confusion here of points of control. So When that's the case, you just know you're in a tightening range. And so you wait for the break in one direction or the other to further position in the event that you get a break to the downside. Below here, you are possibly going for a further monthly back test, and that back test would kind of land you into the whole 150, let's call it down to 145, which could be a decent re-entry opportunity for further swing trade or thematic longs following healthcare higher. Moving on to SMH right now, semiconductors, decent recovery. Tuesday, Wednesday for them weren't that great. And we know that at the same time, they did lose this daily uptrend. Big flush down. The bulls are trying to get it back. Now, will they be able to full V-shape this as if the drop never happened? Or will they have to take the two-step process? Well, that is something that we'll have to pay attention to. But usually, when you have a very nice bounce like this, in terms of the size of the bounce, it's a very nice, respectable 75% bounce. So that does give the bulls a great opportunity to reset the trend higher. That being said, in the event that that's not the case, and we somehow roll it over again, well, we're just still going to be finding ourselves into a phase of weekly consolidation. They consolidated last week, recovery on Friday. If we come down again, it'll just look something like this, right? Another just consolidation phase all in the weekly timeframes. And once again, you'll be targeting maybe the 375 location around the 12 EMA and around this backtest location for semiconductors. Not too bad, right? And now some semiconductors have been popping off their lows. You might remember AMD. I was saying that it was a very good buy after their earnings sell-off. Turns out that indeed so far that has been the case. NVIDIA, after their sell-off last week, we highlighted it down here. That was a very good pickup as well. Maybe you guys were able to nibble on that. And we were kind of just not DCing any further into companies that already ran tons like ASML or LRCX or whatnot. It's not that these companies are not good or whatsoever. It's just that they've ran tremendously. So rather than getting into those companies, we were favoring companies like, Broadcom, which was doing a very nice monthly 12 EMA backtest down here around the lower 300s, or companies like Marvell as well, right? Which kind of dipped down here into the low 70s. That companies that haven't really had their next leg of expansion just yet. So keep that in mind. That's how I'm playing semiconductors. I'm playing the laggards that still have very strong growth profiles ahead of them, rather than piling on to names that are somewhat already extended. Now, if we're in these, and I do have a whole bunch of ASML, right? I'm just kind of just holding these for now, not really trimming them or whatsoever, just holding as they're part of my long-term portfolio. So keep that in mind. And now the Russell, taking a look at the Russell real quick. 0.7% to the upside, very nice recovery. The Bears had the daily downtrend going. The Bulls, nice engulfing move. So now they'll be seeking to get this daily uptrend back. We always had that bias coming into these lows. Why? Because the bulls control the higher time frames, right? Nice weekly uptrend right now. Came right down in the 12 EMA. We were looking for maybe maximum pain being down here in the 250 location. Didn't quite get there, but it was always the case that we were looking for a higher low, going for further expansion. So the small cap trade remains a very popular trade. And whether you're using the Russell as your small cap investment vehicle or going for smaller individual names, the Russell is just a combination of all of them, right? All very valid setups, whether you want to do it individually or through the Russell on these pullbacks, very decent indeed. If you take a look at some further rotations here, XLP, a bit of a pullback, but look how solid this one has been since the start of the year, guys, right? Year to date, this one's up 12.51%. This is the biggest rally that staples have had, arguably in the last, let's call it year and a half, right? I mean, more than that, unless you count these lows out of October right there, it hasn't really done much over the course of the past 3-4 years. We've talked about this rotation many times, especially in the videos in January, where I was saying all the video titles were something like 2026 themes and sectors and rotations to look out for. And this was a key theme. So working really well right now. In the event that you kind of falter right now, as we are in short-term overbought conditions, weekly RSI is a little bit overbought, daily RSI a little bit overbought, and they're not known for being overbought as long as something like a semiconductors can stay overbought, right? So in the event that you have to pull back, well, you guys got a clean backtest area, 84 down to 82. Not quite sure if they'll make it the full way, but any backtest here could be a very nice re-entry opportunity, so keep that in mind. Consumer retail also has been a very solid trade recently. If you take a look at XRT right here, they've been breaking out. Take a look at the monthly time frame, which is the cleanest time frame in my opinion. Very nice monthly upswings right here. So consumer cyclicals as well as staples continue to be a very popular trade. So the trend is definitely your friend in this situation as well. So keep that in mind. Utilities also not a bad trade position in my humble opinion too. Cleanest time frame here additionally is the monthly, as we are just in a monthly higher low sequence looking for further upside. Some of my favorite plays that we've talked about many times on the channel are names like Vistra, names like Next Era Energy, names like Vistra, but shout out, there's many, many, many more. But Vistra down here, 150 to 140. I like these independent power producers that do service the data centers specifically, but there's also other ones such as Constellation Energy, big nuclear provider, right? They have a very nice back test down here in the high 200s. So keep those plays in mind. Many different ways of playing utilities. I'm playing the ones with the most exposure to the data centers. Real estate has been a quite popular trade. Several segments of it. The REITs are not doing too bad to start off the year. They're trying to go for something right here, right? A little bit of something. Names like Vici could be up for consideration, pays a very phenomenal dividend. We've been talking about it down here. It's at multi-year lows at this point in time. Nice base of support. But also another portion of real estate that we haven't talked about in a minute has been home builders, right? We were referencing the fact that the chart was very clean leading into the end of last year for a bit of a, breakout, recaptured level and retest trade. We were talking about it down here. So far, so good, looking pretty nice for some expansion. And then lastly, some of the mortgage companies like Rocket Mortgage. We talked about it when they kind of fell off a cliff down here, and Rocket Mortgage down here like 18, 17, 16. Decent area if we're looking for a mortgage company that has made several very nice acquisitions recently, such as Mr. Coop Mortgages and such as Redfin, and now are one of the dominant forces in the whole internet mortgage landscape, right? So pay attention to that. And last but not least, good old XLE. So XLE has been a banger of a trade so far, as you can see from maybe not as you can see from the year-to-date percentage. Oh, there it is. 19% year-to-date on this energy trade. Very, very solid. After 4 years, we kind of saw the rotation coming. We were talking about the monthly MACD. That was 4 years, or almost 4 years, 3 years of kind of bearish momentum, consolidation range, looking prime for a possible breakout, especially with all the key themes this year. Data centers, energy, right? A lot of natural gas, midstream pipeline plays have been very popular, and energy just continues to break out. So very, very strong trade right there. It might be getting a little bit extended here on the short-term time frames. RSI on the weekly is a bit overbought. The daily RSI is also overbought, but the trend is very clean right now. Looks like a tech stock, honestly, at this point in time, right? Backtest levels will remain, at your first line of defense down here. Call it about 48.58. So in the event that you do get a backtest and you guys want to participate, that might be your next best chance of entry, whether you want to play individual companies on backtests like Chevron backtesting this area right here, no problem at all. There's also several midstream pipeline companies. We don't talk about these this often, right? But companies like Energy Transfer looking pretty good right there. Companies like Enbridge as well. Enbridge looking very strong. I actually picked up some Enbridge down here on this backtest. They were just looking for a monthly higher low, essentially looking for the expansion here beyond the 2015 highs. And a lot of these companies pay very solid dividends. So it's kind of like a two-part play, right? Energy's popular, but you also get paid in dividends, which have been very popular trades as well at the same time. So moving on to our VIX, the VIX dropping significantly from the highs of Thursday. And as we were saying, right, there wasn't really one catalyst to warrant that. Last week, we spoke a lot about margin liquidations and things like that. The market was somewhat over leveraged in certain aspects. So now that you cleared out a lot of that, some people would attribute this to Warsh being nominated. Some people would attribute it to consequently the liquidations that started in silver and gold, which then poured into software, which then poured into small caps, which were kind of exacerbated by some of the declines on big tech and just unwinds in just the entire tech landscape, right? Some people would attribute this to a portion of the Japanese carry trade being unwound as well. So there are many different aspects to the sell-off, but it's not as if it was as easy as putting your finger on just one, like, Trump's threats to take over Greenland, or perhaps a Venezuela event, or, more recently last week, there was also the whole escalations with Iran. So there's just a whole bunch of little things, like not one big tariff element that we've been used to, not a concentrated market element that eventually breaks down like we had back in October, or many things of that nature, right? It was just kind of an accumulation of little things, one on top of another, and then eventually the straw that broke the camel's back was maybe the Warsh nomination, which then led to all these liquidations. But I wouldn't say that that's necessarily the cause. That's maybe more of a red herring than anything else, right? Kind of just like the smoke screen that justifies the sell-off overall, just liquidating a lot of margin positions, a lot of excess in the market. So keep that in mind. If the VIX spikes up back again, you guys know, very solid environment to be selling some put options in. especially on some of your favorite companies that might be down 15, 20, 25% from a local highs, especially if they're high quality businesses and there was nothing wrong with their earnings and maybe they just sold off because of sentiment. Very strong. I wouldn't say that it's the case that we can write puts on all companies. Like there are certain software niches that I might not touch right now because they've lost a bit of predictability and clarity. But, you know, Mag 7 names and things of that nature, I am a big fan of playing. Moving on a little bit further here, down to our metals trade. So gold, not too bad of a day on Friday. On Friday session, it was up almost 4%, and Monday up almost 2%. So nice, decent recovery. I mean, the bulls are trying. You can see I have some yellow lines here. That's your structure, right? So big liquidation break. And now we had to wait for them to resume, or rather recapture structure. And we were saying that in an environment where you give back 100% of the move, it's very tough to go for the straight V shape. If anything, the best chance that they have is the two-step process. And it seems as though that's what they want to do right now. You need to break and close above roughly about where we are right now, 5,075, right? Give me a clean break above, you recapture your daily uptrend. Not too bad at all. So that being said, if we're looking for that expansion trade, stop loss would go below this area right there. Expansion trade obviously would be 56.25, your all-time high targets, and then maybe further expansion into your round 6,000. Not the worst risk to reward, but at least now we've kind of waited for the price action to confirm, because the last thing that you want is to buy right about there and then just get unwound. Just like some people on silver, it happened to them, right? Where you kind of buy the dip, you get unwound with a lower low without confirming structure. So the structure on gold holding up a little bit better. The bulls holding up at this current stage, but the other option is that we just kind of devolve into some form of a tightening accumulation range. You kind of let the longer term EMAs catch up to the price. You cool off some of the RSI levels a little bit, and you also let some of these monthly indicators cool up, catch up to the price as well, because we are in overbought territory on the RSI on a lot of these metal trades still. And silver, that being said, well, silver doesn't have the best price action in relation to gold, but the bulls are still trying for something, right? Big drop, second element of the drop, but you can see the bulls weren't able to recapture much of this bounce, right? This arguably was only a 30-something% bounce from the drop. Now, this one is a bit better, right? Take a look at the fib bounce on this one. It lets you know that, well, the bulls are getting more and more ground for every drop that the bears make. This one right now, a healthy 61.8% bounce. So that being said, what you still want to see, guys, you still want to see them recapture structure, because if not, well, it's still a daily downtrend, right? This is still a lower high. You'd want to see a higher low and then try for the break, exactly like what gold did. Gold is giving you the pattern, right? Set the higher low and then give me the higher high break. Then you can say, okay, the short-term bulls are back in control. That is possibly your weekly low, and then you might be looking for some re-expansion. As of right now, still unclear. So for me, gold has the more clear price action, but silver is still benefiting from a nice sell-off here, selling off from the all-time highs or selling off from the overbought RSI as well. And the weekly time frame here, now back into the 12 EMA. It was a very nice pullback in my humble opinion. Not quite touching the 12 EMA, very close. So maybe the metals need to consolidate a little bit more. We will just have to wait for the price action to tell us overall, which is why we wait for our time frames to confirm for a lot of these trades, right? Now moving on to Bitcoin and Ethereum. Well, Bitcoin and Ethereum, brutal days, right? So Thursday was a disaster, and Friday they were able to recapture a little bit, but we haven't really done anything for the past 4 days, right? Big liquidation break, big clawback right here, and now just absolutely nothing, just silence on the charts the past 4 days. But the one thing that isn't silent is the price action control, right? You can see we are back into the 200 weekly EMA on Bitcoin, back into 2024 highs right there, the lows of the tariff sell-offs as well. And we just broken down all structure, right? The daily, we're still not in a new daily uptrend right now. We are into a support level, but it doesn't mean much, right? I mean, that happened here as well. And you can see what happened is we were never able to confirm the higher time frame break. It just couldn't happen, right? Turned into a bear flag, right? Soft bounce, bear flag, which we warned about as well. And now we're kind of all the way down here. So step number one for the bulls is give me a nice daily uptrend. That's step number one. Then we will seek to understand whether or not that upswing can translate into a recapture of the weekly time frame. Unless you get a weekly uptrend, you can't say that that is indeed your monthly low or the cycle low right now. You've engulfed this move entirely, so you've now lost the monthly uptrend. It's going to take a while to get back. And the same thing can be said about Ethereum, right? Ethereum coming down to a very low price. They tagged last week 1755. Same concept, right? It was a weekly downtrend into a support range, and we were very patient. We gave the bulls many chances to prove to us that they wanted to go for the weekly expansion trade, couldn't get it done, wound up being a bear flag. which you kind of caught while it was happening, right? This loss of the daily uptrend and then consolidation at the lows. You're like, you better put a stop loss there if you're going long, because if not, you can get unwound in a big fashion. That's exactly what happened, right? So weekly remains in a downtrend. Sure, we are oversold on some levels, but it doesn't mean anything if you can't change the trend, right? Step number one, give me the daily uptrend. Step number two, give me a sizable weekly bounce, and then change the weekly, and then we can say, okay, that is likely going to be your monthly low, possibly your cycle low, and then we could talk about possibly recovering to the upside. But so far, still, crypto, very unfavorable trade, at least sentiment-wise. That's everything for your overall market rundown. Hopefully you guys enjoyed. Now, let's get into some of our big tech names. So we'll try to run through these as quickly as possible to get to the biggest gainers and losers, because I know you guys love that section. Number one, speaking about Apple. So Apple's price action is not terrible, right? Nice daily uptrend right now. Kind of trying to use this whole section as support. 275 down to 266. Not too bad. It's just there's no trade for here. No trade here on Apple, in my humble opinion. The trade location was definitely down in the 250s, and we did highlight that as it was kind of happening on the charts into their earnings. Solid Q4 report from them. Nice product suite to look forward to. It was a nice monthly breakout retest here on the charts. Looking for some expansion. Apple for me right now is a hold for a couple key reasons. Number one, the valuation is quite extended, and number two, we're just not getting the best technical price anymore, but solid. I'm not really selling any Apple shares right now, and I think they should have a pretty good year. Company number two, AMD. AMD had very beautiful earnings. We covered them on the channel last week. If you didn't have a chance to look at them, I definitely would suggest it. We were also saying that down here around the 200-day EMA, 190 to 178 was a beautiful little pocket to be possibly loading up on some AMD shares in the event that you still believe in the long-term thesis, which Lisa Su has been always very clear on, right? The big portion of the growth comes second half of 2026 for both margin expansion, EPS expansion, and revenue expansion as well. And then that starts their big multi-year cycle of growth expansion. So any of these discounts are very well taken, of course. That being said, price action structure, well, still a little bit soft, right? The bears do control the short-term trends right here. We're coming into an area of resistance, talking about the whole 230 up to 215. So in the event you get rejected down here, you might be able to get another chance. I definitely enjoy selling some put options down here, buying some extra shares for AMD, as I am trying to participate in that long-term thesis, right? It's been a nice area down here, psychological 200, but let's be honest, there's not much there, right? Other than the 200 psychological number that we've been using, kind of like a little ghost area, right? Most of the better price action is down here, 190 down to 178, which is why if I'm selling puts, that's kind of where I'm selling right now. Valuation, quite compelling. You're trading at a 31 forward price to earnings at 210 and under a 1 peg right now, which is very cheap for all the growth in the future. Moving on to Amazon. Amazon down about 0.75% today. Nice bounce recovery from the earnings lows last Friday. That being said, the sell-off was pretty steep on Amazon, right? 245 all the way down to under $200. 20% sell-off in 4 days. Now, Amazon is one of the companies that I'm most bullish on in the market, and if you go rewatch my earnings presentation last week, you will understand why. In terms of the short-term price action, though, I mean, oversold conditions, right? Amazon doesn't really hit oversold conditions that frequently, but usually when it does, it is a decent buying opportunity, especially when they have such good fundamentals right now. We are reacting from a key area of support, but we obviously know the short-term price action has been lost. So, similar to like a Bitcoin or whatever, or a gold trade, you need to get the daily uptrend back. That being said, the weekly timeframes do show that we are in a key area of structure that we hadn't really tested since, the May lows of last year, some of the June, July lows as well. Phenomenal company trading at a phenomenal price, 26 EMA on the monthly. So although we've lost short-term momentum, they're trying to defend this area. Fundamentals-wise, attractive. Around 210, Amazon trades at a forward 27 PE at a 1.35 peg. And keep in mind, it will be the first company in the world to generate over $1 trillion in revenue. Yes, they're spending on CapEx, but they need it. The whole premise of the earnings call was that they are supply constrained, and so many of their business verticals are moving in the right direction right now. I mean, 2028 revenue estimates, $1 trillion, right? So phenomenal company, so many aspects to this business. I like this one a lot. So I am accumulating a few more shares, leap options down here, and selling some put options for some wheel income as well. But as we were saying for the wheel coming into this week, right? You got to wait for earnings. And then after earnings, you get some nice opportunities. Today, we were able to find in our Discord group together some phenomenal opportunities to sell some puts. If you guys watched the top 5 options video that I put out yesterday, you would have also possibly be in tune with those 197, 195. areas that we were kind of highlighting down there, phenomenal premium, and in one single day, we made a decent amount of money, and we were able to get out of that trade in the same day and pocket, some very decent ROI. I'll show you guys that at the end of the video. Moving on to Google right now. Google, kind of same concept as the rest, right? They had a very nice daily uptrend in their earnings, and then they kind of got washed, right? So that being said, short-term price action is now lost. We're below some of the daily EMAs, and that is significant for us because we haven't really lost this 26 daily in a very long time. Call it since last June. It's a very long time indeed, right? So perhaps Google might need a bit more time to consolidate. The weekly timeframes are not looking too bad, but if you take a look here, they're curling over on the RSI after being overbought for so long and curling over on the weekly MACD as well. Just something to pay attention to. Google had very strong earnings. Once again, we did cover them on the channel, but if Google goes into a kind of sideways accumulation phase right there, or a bit of a downwards bias, I don't think anybody would find that to be a bit strange, right? After a huge rally, eventually you do have to kind of consolidate, and we will be waiting for this 12 EMA on the monthly to catch up. So Google for me is a no trade situation right now. I'm not piling on any more longs. I'm not short the stock either. I'm just holding my long-term shares. Valuation right now at about 330 is not terrible, but it is somewhat on the more higher end of the range, right? Almost a 29 forward P with a 1.92 peg. So please keep that in mind, but very good growth and very strong earnings from the business. Moving on to Meta stock right now. Meta, another one of my favorite buys in the market currently. They had strong earnings and just gave it all back. So at this current stage, we were always looking for a bit of a higher low. Nice to see they filled the gap right away. And we are encountering resistance right now, 707 down about 680. So the goal here for the bulls is to reclaim this area and go for the daily uptrend expansion. That being said, the weekly time frame is also looking quite choppy right here, yeah? They're trying to go for the continuation of the weekly uptrend, but in the event that you get stopped, and there is this very awkward looking, and I will admit, very awkward looking head and shoulders potential. So whether or not the prophecy gets fulfilled of the monthly head and shoulders, I think that all has to do with the indexes, right? I think you guys agree that if the SPY and the QQQ stay their course and just continue grinding higher or sideways, Meta's probably not going to find a way to drop 20% from here alone without the indexes. So keep that in mind. Meta down here, I mean, couple different opportunities for Meta. If you have a big account, as we highlighted yesterday in the top 5 options video, any declines could be a very decent proposition to sell some puts. 630 down to the low 600 area, around 660 where they trade right now. Very good valuation. So for the long-term investors out there, if you're looking to pick up Meta, very strong numbers right now. 22 forward PE at a 1.17 peg. Very strong numbers for Meta, and the margins have been very strong for this business as well. So please keep that in mind. Moving on to Microsoft, right? Microsoft was up 3.11% today. The damage on Microsoft was significant after their earnings from the pre-earnings move, or section rather, to the peak of the last week's sell-off. That was almost 19% for a company that was already significantly off their highs. Currently, where we stand right now, Microsoft is still 26% off the highs. They pretty much, at this point, guys, filled the entire gap from last May. So at least that gap was filled. That being said, they're bouncing out of daily oversold conditions, but similar to a lot of names out there, they lost all the time frames. So now you got to do the good old recovery process. Give me the daily uptrend back. Then we can see on the weekly bounce size, right? We know it's been a weekly downtrend for the longest time right now. Then they need to get the weekly uptrend back, and then we can say, all right, that is your monthly bottom. Now, that's not going to concern you if you're not trading the stock. If you're just looking to invest in the company, I think it's good down here, right? Lower 400s, solid. We are under the 26 EMA, and we almost touched the 50. That doesn't usually happen. When you find Microsoft below the 26 towards the 50, I mean, you can take a look at how many times that's happened in the last 10 plus years for Microsoft, and you will see really not that many, especially when you combine it with very good earnings. In spite of the market selling them down, right? I mean, around 410, it's compelling. It's a 25 forward P for Microsoft. That's not very expensive. Revenue and EPS growth are very good. The PEG ratio is a 1.34. Solid. Microsoft as well, one of my favorite buys in the market right now. It's a very easy buy in my opinion, right? Moving on to Netflix. Netflix down another 0.89%, but we know this company has so much noise surrounding it with the Warner Brothers deal. I keep telling you guys, just pay attention to this 12 EMA on the daily, right? Clear bear control. And until you see a recapture of this 12 and a shift in the daily uptrend, well, we can't really say that, yeah, that's the bottom, right? It's been like 10 weeks of downside in a row almost at this point. Next area would be that you'd be paying attention to would be 75, which would be the 200 weekly EMA. We're currently weekly oversold conditions. We've been oscillating in daily oversold conditions as well, but you need to show me the trend first. Until that time, stock remains very muted. However, fundamentally speaking, if we're thinking about it for a long-term portfolio, decent down here, 26.5 forward price to earnings and a 1.33 peg. So you can see a lot of these companies, guys, they're trading for like very low peg ratios and very low forward multiples in comparison to where they've previously traded. A lot of these companies have traditionally traded in the 30 forward P ratio range, higher, ones in terms of the pegs, like a 1.8 peg, 1.9 peg, like Google right now, or a 2 peg sometimes, like Microsoft. And now you're finding great discounts all over the Mag 7 list. Moving on to NVIDIA right now. Speaking of other Mag 7 names, 2.5% to the upside. Eventually, at one point today, Meta was up almost 3%. Not Meta, but NVIDIA was up over 3% today. That being said, glorious recovery from the sell-off in just 2 short days. Friday was a crazy day for NVIDIA, up almost 8% and another 2.5% today. So once again, reclaiming the big old area, 185 down to 178 support. Not looking too bad for this stock right now, although the longer time frames just show consolidation and accumulation, right? At the end of the day, I do believe that all the CapEx roads lead back to NVIDIA, so they should be putting out some pretty good earnings here in a couple of weeks when we get to hear from them as well. The monthly timeframes also just show more accumulation right now. We kept saying that lower, 170s down to about 160 range is a great area to be accumulating this company, especially since you know that they're probably going to increase their guidance overall. Keep that in mind. Where we just were at 175, this is why it was a screaming buy, guys. Low 20s forward multiple and around a 1 peg for this beautiful company. So I did benefit from these drops to sell some put options at some of these lows, but also further just nibble on some more shares, as I have been doing every time we approach that area in the past few months. Moving on to Tesla. Not a bad day here either, 1.51% to the upside. Now, that being said, guys, we're into a key area of structure right now, 406 down to about 383. We will see if the bulls are able to defend as well as they did last week. The structure is also lost in terms of the short-term time frame, still in a bit of a daily downtrend. Now, just need to recapture the short-term price action on the higher time frames. Not terrible for Tesla. The weekly still deep into support, and the monthly time frame is arguably the clearest one of them all, in my humble opinion. You're just still in this wide monthly consolidation range, which has been occurring over the past 4, 5, 6 months. Once again, any investments in Tesla should be viewed with the long-term thesis in mind, or else these short-term numbers don't really make sense. So you would be looking for the expansion of FSD, expansion of Optimus eventually into 2027, and the expansion of the energy business too. But shout out, maybe there will be a potential merger of some form of merger with SpaceX and Tesla. That's still on the table as per the discussion, right? Moving on to Palantir right now. Palantir, nice little recovery off the lows, 5.16% today. Little day on a Friday as well, nice 4%. So combined move, it doesn't look like much, but from the lows, Palantir's already up like 12%. Not too bad of a move, right? They did come down very close to the next area we were looking for, which was about the 130 down to about 117 area, really clipping down into there. And in my opinion, guys, if you're a long-term investor, or if you're looking to be a long-term investor in Palantir, here, the lower 130s, as I was saying like last week, lower 130s down about $100 is kind of like your sweet zone for an entry type of stuff, because that would be between the 12 and 26 EMAs respectively. And if you're looking to buy this high quality company on a discount, of course, yes, it trades rich, but that's why I say for people that are looking for big short-term gains, they're probably not there anymore, at least not to the effect that some people were able to buy back here, such as myself, in the whole $10 to $30 range, and then you saw a very rapid expansion, depending on your price, 5-10x plus over a short period of time. Those easy gains are probably done, but if you're looking to buy a high quality business after a very prolonged period of monthly consolidation into some very attractive levels in terms of some holds for the next 5+ years, as Palantir just continues to execute on its business model. Palantir is a unicorn company. It's a one of one. So yes, the valuation is somewhat expensive, but somewhat justifiable if you have a longer term time horizon. Moving on to SOFI right now. SOFI, 2.35% to the upside. Also, not too bad of a bounce from the lows, right? They're trying to make their way back into this whole lower 20s up to about 25 area of support that they lost on the daily, but didn't necessarily lose it that much on the weekly time frame. So you're still holding on by a hair, a very thin hair right now. Weekly downtrend, obviously we know that. Daily downtrend as well, out of oversold conditions. So step number one, as with all the other charts that we showed, get me the daily uptrend back. Then we can talk about this being possibly a weekly low. Then you need to get the weekly uptrend back as well. And then only then you can talk about that being more of a monthly low or possibly a monthly cycle drawdown low as well before SOFI possibly approaches the next leg of expansion. Now, we covered them after earnings. We did say that below here at $22 all the way through the high teens was indeed a very nice buying opportunity if you are a long-term investor. And I did pick up some leap contracts on SOFI last week during the decline as well, and I continue to play the wheel on it too, meaning short puts. Shares, I'm not really buying any more shares. I got all the shares that I possibly need, and we bought those last year around the $10, $11 range, so I'm still holding. I'm not adding any shares, but if I were looking to add some shares, not a bad location to do so. Valuation somewhat still very compelling down here in terms of forward PEG ratio and price to sales. Moving on to Uber right now. Uber down 1.15% today. They had a nice decline on earnings, and they haven't really gotten that big of a bounce out of those earnings. As a result, daily downtrend, same concept. Give me the daily uptrend first. Then we can talk about maybe this being the end of a brutal weekly downtrend, months-long weekly downtrend at this point. Got to get the daily, then give me the weekly, and only then we can say, all right, that might be your monthly retracement cycle low, and then you might be looking to expand the timeframes on Uber. However, if you're not trading it, then you wouldn't be looking at that. You'd just be looking at, well, the longer term timeframes. The monthly, very clear action right here. Big previous resistance zone, current support. And in comparison to previously, back here in 2024, the company has much better fundamentals, right? Improving revenues, improving free cash flows, improving EPS over that time. So that being said, around 75 or under, it's trading at a very low multiple right now. A 22 forward PE, a 1.11 PEG, a 5.6% free cash flow yield. So there's many companies out there, guys, many very high quality businesses, if they are your cup of tea, that you can be picking up at relatively very fair valuations, in my opinion. And Uber is just another one of those. So nice technical setup here for a bottoming out location into a lot of price action from previous history, but also a very compelling valuation. And last but not least, good old Taiwan Semiconductor. So TSM up about 2% on the day. Not too bad of a day. TSM, beautiful engulfing move, guys. They went for the breakdown. The bulls said no, and gorgeous engulfing move off of those lows. So now you will be looking to reset the price action into the daily uptrend. When you get the nice engulfing move like that, the bulls have a very high chance of, or very high probabilities of executing that. The weekly uptrend remains very poised right now as well for some further expansion, and the monthly time frame never really lost some steam, right? TSM has just been fully gassed since those April lows of last year after the tariffs, never really pulling back too much, offering deep discount entries. That being said, TSM remains a hold for me. I'm not really adding any shares up here. I'm not selling any shares, just a very consistent hold at this current stage. At 340, your valuation is not too extended right now. 26 forward P, a 1.37 PEG, and a 9 forward price to sales. So, I mean, it's not expensive by many metrics. It's also not very cheap. It's kind of right in the middle there, which is why it's not one of my favorite opportunities in the market right now. It's a very strong company to hold, but I wouldn't necessarily be building a massive position on TSM up here either, thinking that I'm getting the best deal of all time, right? So that's why companies can be buys, sells, or holds, and this one still remains a bit of a hold for me. I would enjoy seeing more of a pullback. I was kind of waiting maybe to see if they would drop TSM back into the lower 300 range during last week's consolidation phase. They didn't quite get there. That's fine. Many other companies did hit my buy target, so I'll focus on them instead. And that wraps up our entire first portion of the watch list and the overall market rundown. So hopefully you guys enjoyed those segments of our video today. Now let's spend like maybe 5-10 minutes discussing some of the plays on the biggest gainers and losers. We're not going to go through all of them, but once again, just tackling some key themes, and I'll kind of break them down into some companies that I'm looking for short, medium term, and then some companies that are very compelling for some longer term investments as well. So number one, biggest decliner here on the day on my list at least was Pagaya Technologies. Now this is the one that I've spoken about a few times, and I have said that this is a very interesting business, right? To build positions in the lower 20 range down to the teens, and it is there. And I have been building a bit of a position on Pagaya. My first buys on Pagaya were just around here under the $20 mark, and I did add a few more shares today. But once again, this is a small cap company, and it is in the fintech space. It is AI loan matchmaking. The reason that it declined so much after earnings today is because of soft Q1 guidance, both for net margin expectations, but also for revenue expectations as well. You can see that their earnings were not bad in terms of EPS. They did beat. The revenue came in slightly underwhelming, but it was really in terms of the guidance. And we know that Wall Street has been very picky this quarter for earnings, for guidance, and whatnot. It is a $1.14 billion company. The reason that I enjoy this one is because they've pivoted from a non-profitable business to now a positive net margin business. Now, as well, we also can notice a subsequent pivot in terms of your EPS, right? So usually when a company pivots from negative to profitable EPS, I really start paying attention very closely. You'll see that most of the analyst price targets are considerably above the stock price right now. And the revenue growth profile is very fair in my humble opinion. It's a $1 billion company overall, market cap wise. And this year, they're going to be making about 1.5 billion in revenues. Next year, 1.74. So decent, attractive valuation. But we know that, Pagaya has been out of favor recently, but the whole fintech landscape has been out of favor. I mean, you need to look no further than perhaps something like a PayPal, or even names like the buy now, pay later names like, Affirm has been dropping a lot. Klarna has been dropping a lot as well. My favorite one there, obviously, is Affirm. And even names like SOFI and Robinhood, right? So all these companies are obviously not the same. It just goes to show that a lot of the fintech space, brokerage space, anything having to do with certain growth aspects of financials have been beaten down, and Pagaya is no exception. I wouldn't say there's a fundamental problem with the business. I still like the model. I like their EPS expansion, just to buy the dip opportunity. But this comes with the territory, guys, of investing in smaller cap companies. They are higher beta. So of course, they will swing very violently. It is your job, if you have a multi-year thesis on this company, such as I do, that I understand that perhaps some of my buys here will not be rewarded instantly. I'm just looking for more share ownership. As I just continue to increase the share count, I will hold until the fundamental thesis comes into play, into expansion. And if ever I have to revisit this thesis because it's dead in the next, 6, 9, 12 months, well, I'll do that at that point. But definitely nothing wrong initially right now, just a bit of an earnings reaction to the downside, at least in my opinion. Moving on to second company right now, HIMS. Now, HIMS. Once again, down 16% on the day. There was a couple pieces of news there. Once again, they're being sued by Novo Nordisk again. They're dropping their, by Eli Lilly as well. They're dropping their oral pill for GLP-1s too at the same time. It was supposed to be a nice revenue growth driver for them. They're not going to do it to compete with Eli Lilly, because Eli Lilly said, no, don't do that. We're going to sue the hell out of you. So HIMS has just been marred in controversy over the better part of the last 6 months. And it's unfortunate for them because, they're a company that, although a substantial amount of their revenues do come from weight loss derivatives, the thing is that they have more products than just that, right? They do many different things. It's a telehealth company at the end of the day, and their product suite is getting larger and larger, but they've been very lumped up into the GLP-1 category as of late. And to be quite honest with you, that serves them in times where that expansion phase is going well for them. That's what really contributed from bringing them to $25 to $70, not once, twice, 3 times, 4 times, but now it's kind of the inverse, right? It's a double-edged sword. That's also contributed from bringing them down from 62 to where they are now after so many negative pieces of news elements on there. So, I mean, weekly oversold conditions right now, the daily deeply oversold conditions right now at about an 18. And this company says its pros, it has its cons. One of the major cons is who it competes against, right? Whether it's Novo Nordisk, whether it's Eli Lilly, whether it's just Amazon for several other services. Amazon is big in the telehealth space now as well. So I'm not saying it's a bad company. Some people have issues with the management team and the CEO, and that's completely understandable. The company does still have 2030 guidance up there of about $6.5 billion in revenue. And right now at about $19, they're about $4.4 billion. And the company makes money. Like, that's not the question, right? They make money, they make net profits. It's just the sentiment around this business has been quite bad. This year, they'll make $2.35 billion. The next 2026, as we wrap up calendar year 2026 for them, they'll be making closer to $3 billion. So, I mean, valuation-wise, in terms of forward price to sales, let's just be honest, you are getting a discount. Whether or not you want to invest in this company with all the competition risks, that's completely up to you. I think they'll still have a good chance of, monetizing their consumer base, growing their consumer base as well. But it's the competition aspect of this business that a lot of people have some issues with. So this one now is kind of in like the lottery section. Will they be able to, because there's a lot of unknowns, right? Certain people are very firm on saying, yeah, they'll be able to carve out their niche, even with steep competition in the weight loss aspect, because they're doing many other things, right? That's perfectly normal. We will cover their earnings probably when they have them. I'm very curious to see what management has to say about all this. No position on HIMS for me right now. I will be looking forward to these earnings, and then maybe after earnings we'll get a bit more clarity on the direction that the company is taking for one of their biggest revenue drivers, which is the whole GLP-1 segment, whether injectables or they're now discontinued oral solutions as well. Moving on to the next company on this list right here. So Elf Beauty was down 9%. Now, let's be honest, Elf Beauty, I didn't cover them on the channel, but I will be honest with you guys, they had great earnings. Massive beat on EPS right here. Revenue beat as well by about 6%. There's a few little elements with Elf Beauty that, I should do an earnings call for you guys, but we just didn't have the time. But Elf Beauty, the thing with Elf Beauty is that their acquisition of Rhode has been really paying them strong dividends as of late, as that brand is full international expansion. But the overall Elf brand has just slowly declined. And I'm not saying decline like negative. I'm just saying it used to have very phenomenal growth rates, and now those growth rates have been tapering back a little bit. Now they're still moving into many international markets, and I would argue that it's still a brand that is loved by their consumer cohort, but they got a little bit of flack because people weren't, didn't really enjoy their Super Bowl ad. Now, I watched the ad. I mean, there were some pros, there were some cons to it. Like, I get it, but I understand why some people didn't like it as well. Like, I would say that I'm pretty much impartial. I didn't like it. I didn't love it. I didn't hate it type of thing. They went down 9%, and they had a nice earnings pop, and they gave that back as well. But down here, the valuation, if you're an Elf Beauty investor, I mean, you're just going for the fact that the company is a great business model and a very loyal consumer at this point. The valuation down here in the 70s is as compelling as it's always been. It's under a 1 peg. It's low 20s forward price to earnings, but we know it's been a very difficult segment, right? Like Estee Lauder, some of the beauty names have been down as well, right? Beauty and cosmetics has been a very tough segment for a lot of components in the market. One of their other competitors, Coty. I mean, I don't really like this company, but it's just a competitor. Another one, technology company, but it has a few beauty brands within it. Oddity Technologies, right? There's been a lot of them that have been down. It's been a very tough category, but the one thing that I can say about Elf Beauty is that it's the best performer in a very tough category. This is pure play consumer discretionary. So until consumer discretionary companies start getting a lot more love, I don't believe that Elf Beauty will see the rapid, inflection point in the chart just yet, but still a company that I still have long-term shares in. It's not a massive position for me, but it is still one that I like at $4 billion as a play on this aspect of consumer discretionary. I am a fan of it, but like I said, it's a relatively small position for me, but it's one of my favorites in that whole segment. And now I guess one of the last ones that we'll cover for in terms of like smaller stuff, because a lot of these are just smaller cap companies. TE Energy for me is a buy, $7 through about $5 if they go through the full downswing. It's just pure play solar, right? Pure play North American vertically integrated solar. It hits a few key themes. Number one being the full 100% American-made, American-sourced solar, right? So it hits the nationalist theme that we're kind of going for this year. It hits the big energy requirement theme. Tons of news, interesting news on a weekly basis in solar. I present as much to you guys as I can on a weekly basis, but this is one of my favorite small cap trades that I have in my portfolio. Fairly big position for me, I might add. So any consolidation down here, I do think it's a great opportunity. The company is about a $2 billion market cap and will be generating just phenomenal amounts of revenues as they scale here over the next few years. You can see this revenue profile is very attractive through 2027, 2028. So it's a longer duration play for me, not necessarily a short-term swing, even though my cost basis is largely under $4, between 4 and 3, and I'm up a lot of money right now. No premise for me to sell the stock just yet. I am looking for a larger expansion trade, so now might just give us another opportunity to further accumulate some positions. Those are some of the small cap names. Some of the large cap names that I like, I mean, we've talked about them many times previously earlier in the video, but let's say you skipped over those segments. I mean, Visa, MasterCard, in my opinion, no-brainer buys. Moody's Corporation, SPGI, in my opinion, arguably no-brainer buys as well. One company that's been coming down that was on this biggest losers of the day list, Booking.com. You may notice that the Head and Shoulders prophecy is once again on this chart as well, right? As they maybe are manifesting a bit of a rollover down here. Booking.com, such a solid company. They got caught up in the whole AI software sell-off narrative overall, and today again, you know, Expedia coming down from the highs as well. Airbnb coming down from its most recent move up to the 140s as well. The two that I own in my portfolio are Airbnb and Booking.com for long-term positions, not short-term swing trades. No. I'm talking multi-year long positions, right? Because they have the best deals, guys. And I mean, I know that the LLMs and chatbots and whatnot are able to piece together a nice trip for most people, but at the end of the day, these wholesale distributors of travel packages, right? They have the best deals with the hotels and with the airlines directly. So that is their true moat, right? It's the integration, it's the network effects that they've built over such a long period of time. And Booking.com, the last time they had earnings, we covered them on the channel. They had very, very, very strong earnings. We will probably cover them when they have earnings next week as well. But phenomenal sell-off opportunity to capitalize on if you're a long-term investor and you wanted to be exposed to some travel stocks. I think Booking.com has probably one of the most solid business models of all of them. And then Airbnb, for a bit of a niche trade in there as well. Very strong long-term stock opportunities that we can kind of talk about on this list of decliners overall. I think those are the main ones that I want to cover that were kind of down on the day. We will be covering Spotify earnings as they report just tomorrow, essentially, right? So we'll be covering those. Those have sold off in a big fashion. But, you know, a few other plays for long-term positions, not necessarily for short-term swing trades, because we talk a lot about short-term swing trades, but long-term positions, we'll explore Spotify tomorrow. But as I said as well, Shopify gonna probably start buying the stock very soon, as they have had a nice pullback. And I think they're like a one-of-one company in the market right now, right? There's not many companies that do what they do in terms of just the e-commerce network, e-commerce marketplace that they've built out for other small and medium businesses out there. And even they serve large businesses too. So just a very solid company. Valuation is, I'll always trade it a little bit rich, but in my opinion, they do deserve it. We'll talk more about them throughout their earnings. And then as well, we have another interesting company that I'm thinking of building a position in for a long-term hold. Another company, in my opinion, that is arguably a one of one. Now, some companies do a little bit of what they do, like Motorola Solutions offers some, you know, two-way walkie-talkie channels for either military purposes or police force purposes across the world. I mean, Motorola stock is, you know, been on an absolute tear the past few years as they kind of specialized into those niches. But Axon is just a whole ecosystem. It comes with the body cams and many other different things. We covered them last on their earnings on November the 4th. We'll probably do their earnings as well coming up into you know, the end of the month of February as well. But Axon coming down significantly. They've also sold off in a pretty meaningful way. The company does trade rich, but in my opinion, does deserve a portion of that rich valuation. So Axon down here, lower 400s. I'm a fan of picking up some shares for a long-term portfolio just because of the ecosystem and this company being kind of like a one-in-one in terms of what they do. And also a company like ISRG. You guys know that I started buying ISRG last year under 500. And every time it drops under 500 towards the low $400 range, I always love accumulating some shares of ISRG. We last covered their earnings end of January. I'm still a big fan. This one as well has sold off. Lord knows why, right? Sold off from there into their earnings, which are very strong, and also got brought down with the rest of the market recently. So ISRG also a nice longer term buy for me. So those are some longer term buys I'm also exploring. Shout out to Reddit as well. Very interesting. I gotta say, very interesting down here at 140. Phenomenal net margins, good user growth, great revenue and EPS growth in the future as well. At 140, we did not cover their earnings. Maybe I can squeeze it in this week, but very compelling situation on Reddit down here. Buys in the 140s have a great chance of being rewarded. It's daily oversold conditions right now, not weekly. The weekly's lost the time frame right now. Monthly is also lost the monthly higher lows that were planted down there at 174. So it may take a moment, and by a moment, I mean it may take a while to recover to the all-time highs that we saw just a few short months ago. But there's starting to be pretty good value here on Reddit at a $27 billion market cap right now when the company is growing revenue and EPS very aggressively. Right? Beautiful EPS growth the next 4 years, beautiful revenue growth as well. So keep that in mind, right? They're not trading that rich anymore. Matter of fact, you could argue that on many metrics, they are trading fairly cheap, right? So keep that in mind on Reddit. Reddit is also something that I'm considering, maybe starting a bit of a position in. The rest we've always talked about so far, right? Affirm, you guys know, I'm very bullish. It's my favorite buy now, pay later trade. And those are just many of the names that I wanted to highlight as part of the whole longer term investments, because we talk a lot about these, these themes. Like, you guys probably know my stance on IRN, on NBIS and things of that nature. NBIS, we talked about it all last week, right? NBIS was a clear buy. They have earnings on Thursday, so we'll see what happens. NBIS 80 down to 60 was a clear buy for me. We made a good case for Credo as well in terms of a data center connectivity play. They had earnings today after the bell. They're up to about 140. Very solid play. Lots of growth there. Celestica as well as part of that whole data center connectivity play. Cheap valuation in my opinion here. Accumulation range, very decent. Some of these second order AI trades, in terms of just not the data centers themselves, but what goes into the data centers. ANET, you guys know, has been one of my favorite players on that front. The few times that it did tap down here, lower 120s, it was a buy, in my opinion, as well. So keep that in mind. So there's many trades up here. IRN for me, we talked about it after earnings last week. 40 to 30 was really the buying location if you were interested. The same thing could have been said for CIFR down here on this 12-month EMA, which was gorgeous, 13 at about $11. So maybe you guys were able to capitalize on some of those earlier declines. If you were, congratulations. If not, it's okay. Maybe you get a second chance if Nebius comes down a little bit there. But I think that's most of the key core themes that I wanted to address in today's video. Obviously, there's many more, but we'll try to talk more about them as they kind of rotate in and out of favor here on the daily timeframes as we cover this list on a daily basis. So that's everything I had for you guys for the biggest gainers and losers of the day portion of the video. Now, let's jump into my portfolio, and I'll show you guys what we have for the rest of the week, essentially, right? Okay, so for the portfolio, number one, I'll just show you guys a bit of the swap that I made today. There were some nice opportunities recently in the markets for some short puts, which we talked about many times. The first one that we did was that about a week ago, we opened the NVIDIA 175 short puts. It was a bit of an aggressive trade here for $3.60. And you can see that today we made a bit of a swap. We closed them right at the open, arguably for about 99 cents, which is a great, like 67% profit, or excuse me, very nice profit here. That was about, sorry, that's the next one. This one was 99 by 360. We captured about, let's just call it about 73% of maximum profit on this one. It was a contract good through Friday. So instead of just keeping this one open till Friday, I took advantage of the Amazon decline this morning to write a 197.5 for February 20th, 2 weeks away for $2.43. And we were able to just close that one the very same day for about 82 cents, 67% ROI in one single day. So gave us all the buying power back, closed the NVIDIA for a nice profit, opened the Amazon, closed the Amazon for a nice profit. So now we're starting off the week with some very decent wheel profits. So when I show the portfolio, you guys will understand that those trades are no longer there, which is why I also have a lot of buying power heading to the next week of earnings. Now, a few things that I've done recently since I haven't got to see you guys a lot, right, is that we closed a few trades, and I'll explain why. So over the past week or so, this is the past 2 weeks worth of closed trades since I've been kind of traveling overall. You can see we had some success in terms of some wheel trades, smaller wheel positions overall, some new assignments in the names of Zeta at 19, UiPath at 13.5. Got assigned those last Friday. And we did close some losses here. So number one we closed is Rubric. And the second loss that we did close here is IBIT. Now these are positions that I started last year, and Rubric, we were really looking for this area to hold. Rubric was the whole low 60s. When we started breaking down below here, and I noticed that it was kind of being bunched up in the whole software space, after posting record earnings for Rubric, they just sold it off more and more, gave everything back, right? And keep in mind, those leaps were for January 2027. So what I chose to do is a bit of a pivot and swap for something else, which we'll talk about. Nothing wrong with the business per se, but they were call options. And call options, you kind of don't want to run out of time. Not that January 2027 is close, but I did add some 2-year leaps on other things, and I was able to avoid the kind of second leg of this decline. Very strong business, have nothing against the business whatsoever, but just trying to be a bit capital efficient. And the same thing was Bitcoin. So Bitcoin, I started my first position on IBIT when Bitcoin was trading roughly around the $90,000 pullback range, or sorry, the higher 90,000 into this whole support structure area as we kind of back tested it. And then I added a second contract into the second layer of consolidation down here with the premise of saying, well, if they kind of crack below these lows, I'm out and we'll reposition the capital. We were trying to go essentially for the monthly upswing in one clean phase, right? This was kind of like last chance to dance when they were down here, which was the period of accumulation on the weekly we were talking about. We gave them a chance and they started breaking down here. I was able to avoid the second part of the drawdown by just cutting the position as we kind of moved on. I think we cut it about the 28th of January, which was right there after just lack of momentum, lack of follow through, as I was looking for other opportunities in the market. So we cut both of those trades just because they flushed the key levels that we were looking for them to protect, just to ensure that we still had momentum, right? Like Rubrik, I'm not saying it's not a good company. I'm just saying, like, when you forfeit the monthly move like this and you just cut deeper and go into a monthly downtrend, or a Bitcoin, right? IBIT, you forfeit the entire monthly move and you lose all momentum and cut deeper. It just takes so long to recover from that. So I just pivot the capital into things that are possibly already at lows, or maybe that could run a little bit faster. So some of the things that we did pivot the money into recently, right, have been a few more little leaps. So one of them is on Zeta. I got a Zeta $25 strike for Jan 2028 out of the money for $7.15. Now that they've declined a little bit more since that purchase on January 30th, I will be buying another one. So additionally, we did, I wanted to wait until earnings to see if we got any nice declines on some names I was looking for. And I hadn't played SOFI call options in a while. You can say I did load up some more now. 30 strikes for December 2027 for about $4.80. Now, those are currently profitable. Only got one in. I was maybe expecting SOFI to accumulate a little bit more down here. And if they do, I'll be adding to this position with some of the money that we trimmed from the Rubrik position and the IBIT call as well. Other than that, it was just other swing trades that kind of just didn't make the cut, right? Like here you can hear there's a Credo directional trade and a little bit of an Oklo, a lottery swing trade here as well. Just small call debit spreads, right? So Oklo, we were looking for a very clean pattern to kind of manifest. Oklo, we were looking for this. And I took the trade on this candle right here, going for the upswing with the stop loss being a close below our support lows, which did happen. We were looking for something like happened on Rocket Lab previously, where you get a nice engulfing move, you try to reset the pattern and go for the upswing overall. It was a nice attempt. It's not that I love Oklo as a company, it's just a momentum stock, right? And Rocket Lab had a bit of the same pattern back here when we took a very similar trade, right? Big downswing right there. We waited for the engulfing move to happen and switch up the time frames and lead into a bit more weekly momentum. Didn't happen on Oklo, so we did get stopped out on that trade as it did close below. Rules are rules. Maybe it does come back, right? It is what it is. That's perfectly fine. And Credo was the second one. Credo, we took a similar trade whereby we targeted these support lows right here into the whole 130, 120 area, bit of a daily downtrend into a support range. And we took the trade here, going for a bit of an expansion, right? After so long being consolidating, we were trying to go for the expansion trade out of support, just didn't work out. We had a stop loss below the lows right here, which we did close upon the breakdown on this candle right about there. And then obviously they had the breakdown fall through down to about 93 bucks. And now they've since recaptured everything and then now are higher after earnings. But you can't think like that, right? Hindsight is always 2020. They lost the level. That was a stop loss trigger, which is why it's always risk to reward trading, right? The risk to reward profile was a trade like this. And sometimes when you trade, that happens, right? The stop loss was down there. We were targeting some expansion up to about 170. It was a decent trade attempt. It just didn't work out. So those are two that we got stopped out of recently. Very small losses overall, just small little swing trades with call debit spreads, but I figure I should bring it to your attention as you guys do remember those in the portfolio. Other lottery trades included some small wheel trade positions that we did have some nice wins on, but that's kind of the setup that we had over the past 2 weeks overall. So not many new things in terms of, big wins or big losses closed overall, just a few portfolio swaps here and there. So the portfolio now looks like this overall. So year to date, we're down about 5-6%, which obviously is underperforming the indexes a little bit, but keep in mind, we do have a very high beta in this portfolio, yeah? So as you can see on the top end here, we still have our Kraken shares, we still have the Netflix assignment that we've been farming some premium on short puts on DCA attempts to the downside, and one batch of covered calls. Our cost basis on these Netflix shares is not the greatest, I will admit, with the current price. It's about a 96, so we'll just have to stay patient. I'll be farming more short puts down in the 75 range, or if it pulls up into the low 90s, I'll be doing some covered calls. But as of right now, the position, not to lie, is a bit dead money, right? And that's kind of our biggest losing position that we have. In terms of any, it's been a long time since we've been assigned something that's been so slow, but it is the case right now. UiPath, as I said, we are currently about 200 shares into this company. Not a huge position for me. Cost base is 15.24. If they pull up there, we'll be selling some covered calls and try to wheel out of this position. TE Energy in this account is a smaller position for me, but a notable one nevertheless. That one's currently up about 90%, so decent gains. If it comes down closer to 6.5, you may see me add to those. I have so many other shares. I like 5,000 shares in my other portfolios as well. So it is a fairly meaningful position. Zeta, as I said, we got assigned last week at 19. Stock's currently 17.11. So we'll just be playing the wheel strategy on this one as well. And in terms of the long options, guys, I mean, not many have changed. We still got these grab lottery calls with tons of time, December 2027. You might find me adding to them soon. I'm waiting for their earnings to do that. Recently, last Wednesday, we added to a bit of a swing on software. Not a huge swing, but a swing that I like in daily oversold conditions. So we went with IGV calls. Very simple trade. IGV calls, mean reversion trade. Daily oversold conditions, huge weekly oversold conditions, big area of structure, fractured the 200 weekly EMA. So all things leading us to believe that there's some nice confluence down here, at least for a trade attempt. And this one, the way that I framed it is pretty much just, it's going to be X's or pretty much dust, right? So we got the June 90 calls and the June $100 calls. I spent about a total $1,000 on the position, and that's how I framed the trade. I'm saying I'm going into this trade with a dollar amount that I'm willing to part ways with, right? And I'll structure it two different ways. Some deeper out of the money calls, some not too out of the money calls, but if you get a snapback, quick recovery, some of these out of the money calls could do quite well. I wasn't looking for leaps or anything like that because although software is deeply oversold right now and some of the names deserve it, some don't, I'm just looking for a bit of a mean reversion trade. I'm not really looking for leaps because let's be honest, right? These narratives will continue to happen on software companies for the next year, year and a half. So I wouldn't say it's the cleanest trade for leaps, but it is a very nice bounce attempt, and that's what we're going for. So those calls so far have been doing well since our entry at the Wednesday bottoms. We got the Path January 2028 $17 leap call. It's currently underwater. 2 contracts, willing to add to it a little bit more, but notice the duration on all these leaps, right? They're all like December 2027 or Jan 2028. I got like 2 years on all of these, except for these Sentinel ones. Sentinel 1 is my only remaining cybersecurity play. It was never a very large play to begin with, but those call options are down a couple $100. It is what it is. We'll see what happens with this play. Still love the company, but cybersecurity has been deeply out of favor recently. So that stock has been coming down as well. SOFI, this is the new position. Only one little contract. I was looking to possibly size up for a couple more for this portfolio. Have a few other leap call positions in my other portfolios as well. I don't know why it logged me out there. My bad, but a total working with about 10 call options across my different portfolios. So keep that in mind. Hopefully it tries to log me back in here. Give me a second. All right, well, that was very strange. Moving on a little bit further here, we still have the Visa call, which is just doing absolutely nothing. We've been in this one for 4 or 5 months. We still have until June 2027. 320 call, no DCA for me yet. So it's been up $2,000. It's been down $2,000, but Visa just stays range bound right now. Fundamental thesis is not broken, so I'm just still holding this one. Zeta, this is also the new call. I will be DCAing this one as it is now down roughly 10-15% from the stock price where we entered it initially. I initially bought the first batch when it was about $20. Now it's about $17. So I'll be looking to add to this position. You might see me with 2 or 3 more contracts, just building into it. January 2028, $25 call, 2-year contracts there as well. Short puts that we have active, we still have some Affirm 55s for February the 20th. They're moving okay. We rolled these down into earnings, and so far, so good. AMDL was a trade, 2 times leverage trade that we took after earnings, $11 short puts for a whopping 55 cents in premium, which is very good. March 6th, I put a lot of time on them just to benefit from the share price after that decline. We'll see what happens. I don't always play 2 times leverage plays, but sometimes when the discounts are very, very, very steep and very rapid, I enjoy benefiting from that volatility. Microsoft, MSFU, same concept, February 20th. $31 puts on MSFU after their earnings declines. That trade is currently a little bit underwater right now. But Microsoft, around 415, 420 is usually where this trade is going to be profitable for us. So we'll see what happens. I wouldn't mind being assigned these at, such low prices on both AMD and Microsoft. But you can see very small. When I play 2x leverage positions, I play them very small. UiPath, this was just another DCA contract. It's probably not going to happen. We can close this one out tomorrow. It's now worthless. PGY, this is a trade I took today after the decline on PGY. 13 puts for February 20th. We got those for 60 cents. Trade's currently working in our favor. SOFI 21s. Never got assigned SOFI so far. Didn't close a loss on SOFI either. The reason being is that into their earnings, we had the $22 puts for the Friday of earnings. Those ended up worthless. And then the following week, which was last week, we wrote these new $21 puts at $21. And it broke below 21. It's now back above 21. So we'll see if we get assigned at 21. This is just one contract. As I said, I'm playing it with a DCA in mind. So if we drop a little bit further down to 18 again, 17, and I get assigned these, I'll DCA this trade. But so far, no assignment here. TE, this is just one covered call that I've been rolling now for like a month and a half. We've been pocketing some nice premium, but you can see it's 700 shares. I'm just looking to take 100 shares off the table, recuperate a bit of my cost basis from this trade. It would be very nice, like just this one contract with all the covered call premium that I've collected so far built within these covered calls. They're rolled covered calls. And just the gains on the shares, right? I'd be getting back like 30% of my cost basis of a 700 share position with only closing 100 shares. So I'm not looking to take substantial profits, just looking to trim a little bit of exposure, not that I need to. And then we got the Zeta 17 puts for this week as well, another DCA attempt from our $19 assignment, 17, very phenomenal price. February 13th expiry this Friday. We got them for 27 cents. Didn't clip the lows of the move last week. We were a little bit early on that one. So as a result, it is underwater, but I wouldn't mind getting a DCA there. So small, very small things remaining on the wheel. I have a ton of buying power right now for bigger plays. No bigger plays on the table. So ton of buying power for me coming to this week for earnings. Just small plays on assignment and or running right now, other than maybe the Netflix position, which is the largest wheel position that we have either running or assigned right now. And then to the downside, more leaps down here, right? So the AMDs round tripped a portion of their gains, but look at all these leaps, right? These debit spread leaps, they're all for December 2027 or Jan 2028. Now, the one little one that's kind of down a lot right now is the Tesla March 470, 475. It was an earnings play. We spent $150 on our earnings play. It's down significantly right now. I'll probably just ride or die those into the ground. Obviously, it's lost a lot of ground there, but in the event Mag 7 recovers, who knows? Maybe Tesla can do it before March 20th, but it's $150 lottery earnings trade. So that's what you get with a lottery ticket sometimes. Other than that, these same leaps that you guys have seen now for months and months and months. AMD, Amazon, CoreWeave, FLNC. FLNC round tripped a lot of gains recently with their sell-off, but I mean, it's Jan 2028. 25.37. I paid $1.85 for these. Maximum profit is $12. So like all these risk to reward profiles are very good. NBIS, Netflix as well, which we've DCA'd on, which are down substantially now. But once again, December 2027 with a 114 long call strike, 180 short call strike, a lot of time. NVIDIA, 193.30 December 2027. So all these leaps that I have, guys, I mean, they've been fluctuating wildly, which is why the portfolio takes wide swings sometimes, because let's just say it how it is, right? I mean, you got 19,005 of debit spread leaps here, and then you got about, 8,005 here. So about $28,000 of the portfolio currently is in call options, which is literally half of the portfolio. Very, very long dated call options, but call options nevertheless. So these are all call options, the second batch of leaps that we've built since the month of October. We know the month of October until now has been very choppy. So in the meantime, we've been farming wheel premium very adequately. Some of our smaller bets, such as TE, have been working out well. Some of the other ones have just been down since we bought them. UiPath and Zeta are on the newer side of things. Kraken has been doing very well, another small cap plays, but the leaps remain fairly mixed, right? They run a lot, then they give some back with earnings and everything, and just no clean breakouts, but so much time. So this portfolio is pretty good, right? Nothing to scream home about right now. Bit of underperformance versus the indexes, but I like all the positions that I have. can potentially have some tremendous upside over the next, 9, 12, 18, 24 months. And I have a lot of time on these. Other than that, just continuing to farm wheel premiums. And the wheel strategy so far for us has been working very well. A few assignments here and there, the slowest of which has been Netflix. We've been stuck in that one for about a month and a half in the current time. It happens sometimes, but as you can see, I'm not assigned on, substantial amounts of companies. And most of the stuff that we took in the past week or so, even with the declines, we didn't really get assigned much of anything, just because we were patient and waiting for post-earnings declines. Obviously, there's a few plays that I didn't reference because they're already closed, but still farming premium, still holding most of my long positions. And as you can see, we got a little bit of everything, right? Small caps, mid caps, large cap tech, leaps, call debit spread leaps, playing the wheel, small cap shares and things of that nature. And so that's everything I have for you guys today. So hopefully you guys enjoyed all of the breakdowns in today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. Would love to have you back. We do these every Monday to Friday after the close, except for Monday to Thursday when I'm traveling. And last but not least, guys, if you have any questions, feel free to leave them down below in the comments section overall. So that being said, looking forward to another nice week in the markets, very volatile week of for some of the companies that have earnings specifically, right? But as we stay the course, just wait until these companies report earnings. And if they come down, you can find some great opportunities. So please keep that in mind. YouTube portfolio is not doing too bad to start off the year, all things considered, right? It could probably be a lot worse if I were exposed to the wrong software companies or things like that. And looking forward to sharing more with you guys as we kind of move through time. But the videos the rest of this week, I assume, will be shorter than this because we spent a lot of time today talking about the portfolio because I haven't brought it up for you guys in the past roughly 2 weeks since I've been traveling or something like that. So hopefully you guys enjoyed. That's it for me, man. Take care. Have a good rest of your evening. And I will see you guys tomorrow after the close. Have a good day in the markets tomorrow. Peace.